With historically low interest rates and unprecedented levels of quantitative easing going on all around the world, we can safely say that the stock market is the most overvalued in history. You came here for the truth, so let me unveil that for you. I want to get into this information today. There's so much to cover, so I'm just going to have to touch on a few points and try not to get into too much detail. Let's begin with this article out of the AP. For 6.5 years, the Fed held its interest rates near zero, and for that long, the world has been speculating when the Fed is going to begin to raise it. Then they're saying that's the view of most economists who say that the still subpar economy and still low inflation will keep rates at record lows at least until September. So obviously we have an issue here where the Federal Reserve, among other central banks, have brought their interest rates down to historic lows. This has obviously led to other things that have occurred all down the line. Of course, when you get free money to everyone except for the individual citizens, you have dislocations that occur. Now, initially they said it was going to be the first part of 2015. Then they switched and said it would be the middle or the summer of 2015. And now we're hearing September. These numbers continue to get changed. The dates are never accurate in this regard because they're waiting for a proper time. But if you can't even bring the interest rates up to, let's say, 0.25%, you know you have a serious problem. You can't just bring the Fed funds rate up without it affecting the rest of the economy, because all of the other interest rates rely on the central bank interest rate, in this case the Fed funds rate. Look at this. In 1 in 5 families in the US, no one works. Look at this. A family defined by the BLS as a group or two or more persons residing together who are related by birth, marriage, or adoption. In 2014, there were 80 million families in the United States, and 16 million of them, no one had a job. The situation is very serious, particularly for the real unemployment rate. Look at how many people are actually having jobs currently. You will see a very different number than what the unemployment rate is showing. This is just one thing among many that we can look at. Look at this chart. Income inequality achieves escape velocity after the 1%. So what I'm trying to say with this is that they're always pointing to the 1%. However, if you look at the actual wealth increase by the top 1%, it's not very much. Then when they break that down, you could see it's actually the top 0.01 that has actually made a lot of money over these years. And during the financial crisis, of course, made a large sum. And during any crisis, they make a large sum. But this is basically going to show you since the 1970s, the top 0.1%, all the elite bankers and so on are making all of the money off of us, of course. If we look at this article out of Bloomberg, it always reminds me of how the mainstream media projects that people are saving more money now and the economy is getting better, so they're able to spend on their Apple Watches, etc. But look at this. As it turns out, consumers aren't spending as much of the money saved from lower gasoline prices. They told us that if oil went down, gasoline would go down, and therefore people would have more money in their pockets. That did not occur. Retail sales, excluding automobiles and gasoline, have been below the median forecast of economists surveyed by Bloomberg in each of the last 4 months. They've been lying to us. This is just one more indicator of that. And then we go on to this. Investors are desperately seeking yield in a world awash with meager and even negative returns. Last week encountered a rare opportunity in fixed income. This is where the financial crisis simply happens again. This is the financial crisis part 2. Many indicators are showing us we've moved towards Lehman Brothers again, or even worse. Look at this. Scopus Financial, a 4-year-old auto finance company based in Texas, sold a $150 million bond deal consisting of car loans made to borrowers considered so subprime, you might call them subprime. This is what's happening again. Their lending rules are becoming relaxed, not just in the United States, but in China and other areas. They have negative yields on a lot of the products that are out there now. The banks are trying to charge their negative interest rates in order to force people to get spending. And essentially, what we have is a terrible, terrible situation for the prospects of another financial crisis. Look at this here out of this Greek newspaper. Obviously, now before I read this here, obviously what we have is a situation where Greece is fighting with the IMF, the Troika, and within the government itself, the country's mayors have been divided over whether to follow suit. Following a long meeting on Monday, Greek mayors agreed not to transfer cash, any cash reserves that is, to the Bank of Greece until certain exemptions that they said Tsipras had agreed to have been voted through the parliament. They're actually now having infights occur, and this is not very good for the prospects of Greece, at least in the short term. They're actually not going to transfer any of their cash reserves to the Bank of Greece. Very interesting, because generally the central banks are, they really have that stronghold over all of the other banks. Very interesting scenario going on there. This is huge. Margin debt and net credit balance. Can you believe how crazy this has been since the financial crisis? This massive chasm or schism has formed right here in these things: margin debt and net credit balance. The net credit balance is the red line and the margin balances are the black. You can see the margins have skyrocketed since the financial crisis because, of course, people don't have money. They have to gamble. And then there's net credit balance declining so significantly, and they put the little hilarious thing, absolutely no bubble here. You can see that during the crash of 1987, which was terrible, it's barely a blip. Then you look at the dot-com bubble, you look at the credit bubble, and then you look at the current bubble that we're in, all showing, in fact, even worse than these previous crashes. You cannot deny these statistics. This is an incredible chart that really shows the truth. Now look at this. More overbought today than at any point in history. This is unbelievable. I don't want to get too technical on these right here. I personally don't like to get into the technical side too much, but it is good to reinforce our beliefs and the fundamental analysis. Look at these red lines, obviously getting excessively volatile, and you could see where it's pointing to that it is prior to the year 2000, 2008, and all of the ones before that. Never before has it been more overbought. This is something that is extremely frightening to me. I hope so to you as well. In my book, I wrote about one chapter in particular about the tech bubble, and what we had is a serious situation of overvaluations. And what I said here is that the average PE ratio since 1871, as compiled by economist Robert Shiller, is about 16. During the tech boom, on average, it was double to triple that number. Some even had a closing of, or were closing in on 100 on the PE ratio. You're talking about overvaluations, and guess what? Whenever something's overvalued, it goes back to the mean. It goes back to its average. This is the way it works. If the PE ratios are out of whack, I assure you at some point they're going to come back down. This is historical averages going back to 1871. Why in the world would it be any different today? This is just one indicator, PE ratio. There are thousands of indicators, and I've been covering literally hundreds here on this channel. I'm not going to just show you the S&P 500 every single day and cover it like that. That's silly. We need to look at all of the different indicators that there are, as many as we can possibly get into. Look at this. Biotech, which I was covering recently, is obviously in a bubble, but in a very short order, in a matter of a few days, I believe, dropped down 7%. That is a huge, huge decline in such a rapid rate. We'll have to see exactly what's going on here, but we know when something is overvalued, it has to go down. That's the way this works. Last but not least, we're looking at leveraged fund net position long bond. Essentially, they have never been this short on long-term bonds ever. So right now, they're expecting something to occur. At the same time, we see stock markets like the S&P that have been more overvalued than ever, but really, to be very frank about it, they are at rates they have never been before. So we're looking at an extremely high large amount of money basically moving its way into equities and a lot of leveraged assets. That's what we are seeing right now, as I covered in the chart previous. We have a terrible situation. There is so much overvaluation. There is money basically being squandered by the CEOs. The money is basically being bought back up. There's a lot of stock buybacks that are occurring right now to keep this boom going. I will cover that shortly. I assure you there is going to be a massive level of stock buybacks that occur that make what we've seen seem like nothing. It is all coming to us very soon. Last but not least, if you found this type of video informative, I'd appreciate a thumbs up, and also check out the Money GPS. It's available on Amazon. You can just go over there and flip through the book. On the left hand side, they have this look inside feature. You can flip through the book and see the table of contents. You can see a few pages through there and see if you like it. And that's all for today. If you found it informative, obviously you want to become a subscriber on here. I hope that you will join the near 20,000 others. Take care.